right, ladies and gentlemen, welcome this morning to this first kickoff panel. My name is Eric. I'm your moderator for today to these esteemed panelists. Just background, I represent a single-family office. We have about over $100 million in assets under management, and it was incorporated since 1980. And my range of guests, I'll let them introduce themselves to you later, but they all come from different aspects of the market experience. And it's very interesting that in terms of their background, they complement one another. All right, so perhaps I'll kick off first to introduce the beautiful lady, Jacqueline. Right, she's the Chief Investment Officer at ABE Capital Markets, which is the Australian Bond Exchange. And to her right is Medway, partner of Qin Group. And the far right gentleman is Qin En, partner at Saison Capital. All right, so I'll kick off the session first, and then I'll let them give you guys a more detailed brief about what they do and the company they're with. So to kick off, the financial ecosystem is at a moment of transformation, or it has gone through many iterations of transformation, right? And a bit of history. So when Alexander Hamilton founded what is today BNY Mellon, which is about 237 years ago, it was to finance the economic success of New World. But at the current moment, the frontier has moved from geographic to the digital. So pioneers like you guys and us here, and digital native institutions have made significant progress in creating new ways for financial markets to operate. The evolution of digital assets from a fringe concept now to a mainstream investment opportunity, including growing interest and participation from institutional investors in that space. However, in a most recent article that I came across, there was a headline that says, fundraising by crypto-focused VCs have plunged in Q1, and it's not going to get any better soon. So, Qin En, if I could pick your brains. As a partner in Saison Capital, can you tell us what do you and your team look for before making an investment, given the crunch of funding?
Sure, sounds good. So maybe I'll just do a quick introduction of my firm, right? So Saison Capital, we are an early stage VC investing across both crypto and non-crypto early stage startups. The heritage is Japanese, so we come from one of the largest non-bank financial institutions in Japan, and since 2019 have been actively investing. To kind of answer the question, it is true, right? We see crypto funding has significantly decreased, especially at the early stage. But the way I see it is, it's a healthy kind of correction for the market. If you look at the trends from 2019, 2020, 21, the growth in funding was insane, right? You essentially have every project that if you slap on a token, you slap on blockchain, pretty much you could raise something, right? And I think as a result, it just created a lot of short-term thinking. But what we're really seeing now, it's a lot higher quality projects because it's just not feasible and not possible to just go out there and do a raise without giving it much thought, right? So as for what we as investors look out for, I think a big focus is on long-term value creation, right? It's not just about pumping and dumping, getting a token out and then you're flipping it immediately, right? It's really about why is there the need for blockchain? And even though we are believers in Web3 ourselves, we always ask the question also, right? If I took away the blockchain part, can I get the job done? And if so, then is it just really for hype more than anything else?
You talk about more towards the business model, right? And as part of your due diligence, do you look at the founding team?
Definitely. I think the founding team is usually what is the most important because at early stage, usually we talk to teams pre-product, right? Of course, we look for people with a proven track record of execution. This does not necessarily mean you have to start a company, but I think just, for example, if you want to build something in the intersection of fintech and blockchain, you better know how financial products work, right? Like if you want to offer private credit, then we want to see that you have experience doing things like loan origination and collections, right? It's not the kind of thing that you can just get off off, and today wake up and say, oh, I want to do like a private credit product, right? So I think in terms of that founder market fit, it's important. Also because once we back a founder, we pretty much don't back any other competitor, right? So what that means is we're removing optionality, and we got to make sure you are the right people for the job.
Very nice. So moving on to Medway, similarly as a venture capital firm at Arcane Group, that you guys invest in entrepreneurs, companies, and concepts that accelerate the next phase of digital innovation. Are there any different investment philosophies as compared to Qin En and his team to your team at Arcane Group?
Thanks, Eric. Very similar to Qin En, we have very similar philosophies as each VC, but there probably are some nuances from there. At a very high level overview, we use very simple heuristics, looking at team as a whole, the heart, hand, and the head portion. So just really looking at the three H's itself. At H, head, whether the founding team has a synergy together, whether they have a strategic roadmap down the road, whether the team is being put together to solve the problem which they're trying to do. At the hand level, I think we need to look at the operational excellence of the founding team itself, because in crypto or digital assets, the pace of technological innovation changes extremely fast. I think certain kinds of ecosystems come and go, market crashes from there. So teams need to pivot and change strategic direction from time to time. So we assess the ability to pivot on that operational level. Heart itself, when working with founders, whether it's personal problems or the team problems or financial troubles they go through, I think you tend to see the best quality teams that are able to navigate through all these tough challenges from time to time. I think that's where we give a very simple heuristics on a qualitative metric to assess that team itself. Once that's done, we tend to look at us as a VC on how we can really add value to this team itself. Whether it's a particular segment, it aligns with our thesis, is within our risk parameters, are we overextended, or are we have already invested in the competitor in that space. Then, at the last portion as a sanity check, we start to look at the market as a whole. This is rather from a bottom-up approach rather than a top-down. The founding team has a better understanding of the target market that they want to capture. From a market's perspective, we tend to look at the risks involved and try to actively de-risk the whole deal process, whether it's a regulatory problem, it's a supply chain problem, or a technological problem. Is there economic moat surrounding this team itself? So these are very broad heuristics that we apply to each deal on a basis.
It sounds like you guys have, both of you gentlemen have created like a fun thesis, right? That you need to check all these boxes before you can even have a deployment of the investments in there. Very nice. Okay, so if I could then segue to another environment where many financial institutions across the globe have been working to integrate and expand their digital assets offering investments. Others have realized that they can no longer wait and take the wait-and-see approach. So as they formulate their strategies, they are eyeing the benefits of this intermediation that digital assets offer. But they also desire the risk management and secure infrastructure that they have to come to expect from mature institutions. So I noticed also that there are three key considerations that are driving the demand. The first one is the increasing interest in digital assets. That's why we're all here. Second, the emergence of tokenization. And the third, the evolving regulatory environment, right? So Jacqueline, if I may, as the former CEO of a MES-regulated RMO license, or RMO stands for Recognized Market Operator, and the Capital Market Services License Private Markets Exchange in Singapore, what do you observe as unique considerations and challenges that either VCs or investors like myself, family office, when investing into digital assets, such as navigating regulatory uncertainty, managing portfolio risk, and evaluating the potential of new technologies and use cases? And perhaps later on, Medway and Qin En, you could maybe debate with Jacqueline on her views. Over to you, Jacqueline.
Thanks, Eric. I guess just to give some context as well, in Singapore, exchanges have the unique position or status as banks do and as insurance companies do. We are and we're licensed to issue securities. So that's the sell side. And then on the other side, which is the buy side, we're licensed to represent investors. So to Eric's point about digital assets and where do we see the risks and how do we right size it. So it's very interesting at the exchange. We look at, digital assets, what are they essentially? We're looking at how are assets, resources, uniquely identified in a digital form. So that's the token. So that's with a lot of institutions, and that's also what's happening with Project Guardian. There is recognition that the legitimization of the asset needs to be secure. So in the past, when you invest in equities or bonds or fixed income, we understand what the security is, what the investor rights to the securities are. So as we shift or move into the digital asset token world, there is, to the naked eye, less transparency and understanding of what an investor's rights are when it comes to redemption, when it comes to accessing their yield on the token. So that is very important. So regulation and one of the things is the reliability of policy to legitimize a token or a digital asset, the manner in which that's created and protected, that's very important on the issuance side. On the risk management side for the investor, understanding who your counterparties are. So there are multiple counterparties, and granted, in a decentralized world, the intermediary or the disintermediation changes all your counterparties. So here we have then the digital or the infrastructure, the technology infrastructure providers that now come into the picture. So one needs to understand then their expertise, their platform, the reliability of their platform, the integrity, and actually what is the technology, because I think tokenization can happen on more than just blockchain. So blockchain is one part of DLT. There are other aspects of DLT where tokenization could happen. So understanding that, I think it adds multiple layers of complexity. So I take my hat off to these VC investors here. So if we move up the curve, so first money, second money, which is first money early stage, second money, and then potentially family offices coming in with second and third money. The follow-on investors rely a lot on the initial money going in who have set the terms, and then the follow-on yields that later stage investors get or secure very much depends on what is the outcome from the first money. So I think there's a more phased and just as securities have been fractionalized, tokenized, there is a multi-layer now consideration into investor rights and access to yield. I think that's, yeah.
Yes. In fact, to your point, Jacqueline, just a bit of a background. So I also sit on a board of directors for an investment holding company that two partners and we set up. And we invested into a digital security exchange, what you call them now as ADDX. And we were the very early stage investor, pre-Series A. Along the way, as the market matures in terms of tokenization, we saw, interestingly, large institutions coming in as investors into the exchange, the likes of your UOB, the likes of the Stock Exchange of Thailand investment arm, and quite a few others. So that gave us a very nice comfort to know that the market or the industry players, the traditional ones, are now taking a lot of attention. Yes, we saw the blow-ups of the likes of our sovereign wealth fund investing into the exchange and stuff, but nonetheless, we saw them coming in from a very strategic level, wanting to get involved in that space with a I guess, a mature entity. So that's what we saw. But over to then Qin En and Medway. So in your world of VC investing, does licensing play a very strong KPI, for example, when a new investee comes to you for investment? Whether if they hold a license or not, does it play a very big part in your analysis?
Yeah. So maybe I can go first. I think it really depends on what sector that you're playing in. Once you touch something in the realm of financial services, our expectation is yes, right? And while the licensing regulatory regimes still are in flux, right? There's not always clarity. We expect that is top on the agenda, and it's something that our portfolio founders are ready to go through, right? So if I think back at all the investments that we made that have to do with private credit, tokenization of UST bills, all of these players are either getting licenses or they work with licensed partners, right? And I think that's the critical approach that we have to take, because if you don't get a license, it's not just about risk for customers. You will just always be limited to a particular segment of users, which is mostly your retail folks, your degens, your speculative traders. But if you want a serious institutional money to come in, then you need the licensing, you need to build that confidence.
What about Medway?
Yeah, totally agree with Qin En as well. In terms where, let's say, it's classified as a security or commodity, that's the ongoing discussion that's happening in the US itself. Each jurisdiction has a very different stance in how they classify a crypto, where there's a legal property, classifying lending also as a regulated product, DPT issuers. Hong Kong is moving towards a different regime where they have set up different SPVs that allow you to hold 100% of digital assets. I think all this tends to shape capital flows, which a VC has to consider how it impacts markets. And projects will also gravitate towards which regime is more favorable for that particular kind of segment that they're trying to target by itself. From a portfolio consideration point of view, that legal risk must be addressed right on the onset before we can even proceed further. Taking one step to enunciate this portion on the portfolio risk, I think valuation is probably the key obstacle for a lot of VCs in the digital asset space. Apart from pricing in the legal risk itself, you don't really have much comparables from historicals because it's an extremely new, evergreen kind of space itself. Whether you take liquid secondary markets, which prices are extremely volatile, or the onset where it's a totally new kind of technology which you don't even know which regulatory wrapper it falls under. So how do you price such a product if there's no precedence before that? So in that sense, a lot of VCs have to craft their own heuristic or intrinsic models to price the deal going forward from there.
Very interesting. And in that aspect, both Qin En and Medway, have you come across investees coming to you to say, okay, for example, this is how much they value, and they then consult you to say, is it reasonable? Is it out of whack? You know, are they open to consult with you guys to say, is the valuation reasonable?
These days, a lot more than in the past.
Okay.
I mean, I think valuation is really at the tail end, and usually it's, I think as Medway said, right, a matter of pricing the risk. I think what's more important is, do the founders have enough ownership to kind of be motivated in the long run, right? Ultimately, that's something that is important for us as investors because we are not involved in the day-to-day operations.
So in a sense, you're saying that the liquidity of funds is still there for the projects to look for. It's just that it's getting a little bit more, you need a lot more clarity in their projects in that sense, right? Okay, so then moving on to the next question that I have actually is the future outlook for digital assets as a long-term investment opportunity, including the potential for increased institutional adoption, the emergence of new investment products and vehicles, and the potential impact of technological advancements and regulatory developments, right? So, Qin, earlier I was chatting with you about the type of investments that you guys do, whether it's in fintech or Web3, which is segment agnostic. What's your tenure of your investments usually?
I think for us, because we are a corporate VC, we actually have a long-term perspective in the sense that we don't even have a fund life or a fund cycle, right? So because of that, the way we think it's really in at least a 5 to 10 year time frame. And that also explains why even in this climate, we are still actively investing on average about 1 to 2 investments a month in the Web3 space, right? In a time when there's a lot of fear, there's a lot of concern that, hey, markets are not doing well, liquidity is dried up, we still see the long-term potential of it, and we're playing the long game over here. And it's easier for us to do so because we only have one shareholder.
I see. If I may segue to Jacqueline, earlier we talked about fixed income, which can be used as a funding tool for companies. Yes, sometimes without track record it's a bit difficult, but having that tokenization of fixed income, would that be a new avenue for companies or projects to get new source of funding?
Yeah, so just to touch on that and also to include in what Qin En was talking about, valuation, and same with Medway, it is absolutely very challenging to put a value on a business or a potential, going concern, because at very early stages, a lot of these businesses or with digital token or digital assets based businesses, they are not yet at above the line. They're not yet in the black. So it is very challenging. The price discovery process based on human judgment, as a lot of VCs are embarking on, in and of itself is the risk that the VC is taking. So this is where I see, and this is, I hold MAS in the highest regard. This is where MAS is also trying to address this issue of price discovery. How do you price, and then how do you ensure that following the primary issuances, which is the first issue, and the price determination of that, the secondary market, so there are exit options for the early investors that protect their investment based on also hopefully the going concern of the entity, and what are the different forms of, 1, security instruments, 2, investment platforms. So I think that's what you're talking about, Eric. So what excited me with Australian Bond Exchange, and this is one of the reasons I joined them, is background. Australian Bond Exchange is publicly listed in Australia. They have a subsidiary that is fully licensed with Australia Financial Services license to also serve retail. So that's similar to the LFMC CMS licenses here in Singapore for non-bank entities. That means, and we focus on bonds, which is fixed income. And what we're able to do is, and this goes back to any of you old school bankers from the 90s, we used to create structured products. So we used to monetize, and we used to find assets or revenue streams that can be securitized and monetized, and these are the security instruments. So that's the fixed income portion. So in the digital token space, one would look at where we could securitize a stream of either assets or cash flows and put that, for the want of a better word, non-techie would put that into a token, and that token is the instrument, and the fixed income portion is, so these would be companies that would be able to generate sufficient returns or coupons for investors on an ongoing basis. So unlike equity investments where it's all back-ended with a balloon payment, that you risk the balloon being popped along the way and you don't get anything. So in fixed income, and this is the next project I think MAS is embarking on with Project Guardian, in concert with financial institutions, looking at how we can create different investment platforms or exchanges or other formats like the VCC formats that can issue fixed income instruments. And then that lends to what Qin En was saying, this is like the market valuing approach. The weak will die out and only the stronger entities and the stronger assets will prevail. And this is all to do also with protecting investors, right? At the end of the day, the issuers of instruments, we are looking at how we protect investors. And investors then would be able to get better transparency into assessing the risk and return.
It's very interesting because I'm just hearing from you guys. If I'm a startup or one of the Web3 firms, and stage one, I go to Qin En or Medway for early stage funding, right? And as I go through, pre-series, Series A, Series B, and then to a certain level, as I mature, I may say, I would like to build a deeper reputation. I go to Jacqueline to say, hey, Jacqueline, I'd like to list a portion of my company equity for fundraising in terms of fixed income, right? And it's tokenized, and obviously you built in the coupons in consultation with the investors, and I get more funding in exchange for a portion of the equity. But at the same time, I create transparency or clarity to new investors about my firm. And I find it very intriguing because in our space, family office, when we invest, we do a lot of duty, right? And transparency is something that we hold to the highest level. And a lot of times, even at the ADDX exchange, which I'm an account holder, when I look at the projects, whether is it a Web3 fund, whether is it a private company that issues a 3 months tokenized bond, the prospectus are there. It's audited, right? So you can't run away with fake numbers and stuff like that. So I think the world of new platforms, new way of looking at projects, and the positive side of things is that the liquidity, it's out there. So it's about whether, as the investee, can I showcase a real project, a viable project, right? Okay. So in that sense, if I may now then also go back to Chinwei. You mentioned earlier from your parentage, it's a Japanese firm. Knowing Japanese culture, it's very reserved. How do you guys manage that relationship in terms of your VC investments?
It took us about actually a year to kind of explain and help develop an understanding of the technology. So it takes time. I think that's one thing that I'm not going to lie about, right? But I think what's more important, it's this sense that we need to disrupt ourselves before we get disrupted, right? And I think that's something that is very real. And we realize that if you look at how money moves today, despite all the innovation that has happened in fintech over the past 2 decades, money still pretty much moves the same way, right? A lot of the fintech innovation has happened at the application layer. You have a lot of apps, you have a lot of tools, but if you think about how a dollar moves from Singapore to anywhere outside of Singapore, it still relies on an archaic system that's like 5 decades old. And it's expensive, and you can't send money on weekends, right? Which is like, why? So I think the way we see it is essentially blockchain provides a whole radical new way for how this whole exchange of value happens, for how the dollar can move, and many other things, right? And I think that's kind of one of the key things that it's almost you want to be part of the innovation because it's going to happen with or without you, and it's just only a matter of time. The analogy I always used to give at the start is, if you think about 10 years ago, social media was just a teenage thing, right? No one really thought that it could be serious business. No serious business thought that they should be having a Facebook, an Instagram, a TikTok profile. But today, it's table stakes, right? You don't judge a company whether they have social media profile. You just assume that they have that. And I think that's kind of the view we have of this space, right? Like now we kind of make the divide between blockchain, non-blockchain, Web 2, Web 3. But I think in the next 5 to 10 years, like no one's going to care whether it's blockchain or not, but they expect the benefits of it to happen.
And what about Medway?
Yeah, I think Qin En has articulated the point of the corporations investing in the technology sector. For our firm, we also have a different business line, which is on the digital assets management arm. I'll come in from a different view that apart from investing in the technology side, from the macro point of view, one of the purposes, Bitcoin itself as a store of value. So it comes in more on the credit hedge against maybe the financial sector or a sovereign hedge in the case of a geopolitical tension from that point of view. So the interesting part is the question, which benchmark should we use against? Are we an active fund manager that's trying to outperform Bitcoin? Or do we have a reference rate such as inflation, such as like a sovereign fund? We're trying to get a passive cash flow plus 2% against inflation. So these are interesting discussions that we try to revolve around our asset management portion to have a proper benchmark from there. In this space itself, I think there's a lot of interesting innovation that's happening on the ground despite the low funding in the VC market. Secondary market prices have rallied about 60% year to date itself. We consequently think that the primaries would tend to follow about 6 months lag from now. So that's a wait and see approach. In the crypto space, I think you have Ethereum moving to the proof of stake post-Shapala upgrade. There's now organic yields on the blockchain space itself. It's very different from yesteryear where most of the yields were from rehypothecation, which led to all these kind of crashes. Now you have yields that are organic on the blockchain itself. The second portion in this anomaly in the fastest rate hike over the past 20 years, you have T-bills in TradFi, everyone's going on T-bills itself. In the crypto space, one of the fastest growing segments are tokenized T-bills as well. So crypto is really adopting itself to innovate in this harsh environment, creating new projects from there, building blocks on the DeFi ecosystem. So from that kind of space, digital asset managers can leverage on these kind of organic yields, which are traceable, trackable, auditable, and build foundation layers for the next phase of digital assets.
Very nice. I will talk to you about tokenized T-bills later. Jacqueline.
So I want to touch on, investors' perspectives. I think we're quite clear on the primary issuances and the primary, and then investors in the primary space. I think in all landscapes, all environments, all assets, a very healthy investment landscape requires also the secondary market being there to support follow-on investments, to support, secondary growth. And that as well, then in and of itself, dovetails into what the primary investors in the primary issuances are to say. And that gives protection to any investor and gives comfort to any investor going into the product, understanding that in terms of their own individual cash management cycles, there is a market for the asset they hold. Liquidity, so illiquid assets becoming liquid is one of the aims, as I understand, for the digital asset tokenization space is to ensure that we can bring liquidity. And this is very interesting because I wanted to talk a bit about the illiquid assets. So I come from the world where a lot of assets need financing. They're highly illiquid. It's not being serviced by capital markets. These are real-world assets. These are huge infrastructure that needs to be built. These are, property developers got into the tokenization space early. And what is happening now in this revolution and this broader acceptance of digital asset and tokenization is the ability to bring into the capital market space, which expands the pie of the capital markets universe to assets that previously was not accessible to investors, and let alone at an acceptable risk level. So what's happening now with digital assets and tokenization is we're able to fractionalize huge, very relatable assets, right? Buildings, art, even technology, infrastructure, into these packets. And these packets are in digital format, protected by smart contracts, protected, and then dehumanized or disintermediated, because all the data as to the title, entitlement, the security, the KYC, AML, it's all on the digital stack. So the idea is to be able to automate the entire digital stack for efficiency, security settlements at T+0, so there's no lag, protection in the FX. So the next step then is the secondary markets, right? How transferable is that token? And then the price discovery, as would happen in a lot of capital markets, is the voting mechanism by buyers and sellers, right? The automated voting mechanism. And that takes away that valuation risk, the pricing risk, because the market determines what the value of the asset is based on demand and supply. So, it's very, very interesting now. We see this convergence and intersection of old world capital markets and the new world. And this is why the regulators are coming in and they're developing it jointly, because a lot of the very smart technology is by participants who are not familiar with the, the whole philosophy of monetary policy and the economics of money, which is the entire world and universe of itself. But that world is not familiar with the capabilities of these new DLTs, the NFTs, the layer 1, 2, 3, the public chain, the private chain, and the added cybersecurity that's required. So it's very interesting. I think I digress, but I'm very excited about the space, sorry.
No, actually, you have a valid point, because putting on the lens of a family office investor, let's assume, Qin En, Medway, you guys have invested into your investees, right? And these investees then come on to Jacqueline's exchange, for example, the bond exchange, on a tokenized manner for secondaries, which means that for me, as an investor, knowing that the two of you have gone in at early stage, reputable backgrounds, and when it goes on the secondary, I can partake now, given that it is nicely wrapped within a clarity of the user rights or the investor rights. So that gives another segment of investors avenue to the investees. So I think that could be. I'm really excited.
Access to all.
Correct. Yeah. So in closing, Qin En, you talked about how you guys view, or how you guys would take a look at how the investees come to you guys. Medway, you mentioned about the 3 H's, right? Jacqueline, you mentioned about the popularity or the demand of asset tokenization. So, in summary, maybe for each of you, what would you mention about what would be the future be in terms of fundraising? Whether is it from the audience of investees or investors out there, what would you see in the next 3 years, the impediments, or what are the opportunities? Perhaps from Qin En first?
Sure. So I think over the next 3 years, I'm hopeful that there will be a recovery of the markets, right? And I think more importantly, what we're seeing is new sources of capital that are coming in, especially from institutional. I think what will be key is to continue building on that trust, right? If you think back over the past 12 months in this space, there have been several hits to the trust and credibility of Web3 and blockchain. And a lot of this has taken front and center in people's attention. I think a key thing, regardless of whatever you're building, B2C, B2B, in financial services or outside, it's really how to re-engineer and rebuild that trust with everyone.
Very well.
Yeah, I think over the past year, I think fundraising is just a function of actually trustability as well. So over the past year, we had the collapse of exchanges, hedge funds, stable coins. So I think to really re-engineer and reverse the process, trust needs to be built from there. There needs to be constant education in the blockchain because this space is growing. Everyone needs to really keep up with the technology advancements by itself. So where developments are being made in terms of lending itself, lending protocols, how do we securitize, protect this feature, on-chain, attestations, audits. All this is still an ongoing process to financialize the space. In terms of exchanges, I think now we're moving towards the hybrids where there's tokenization exchanges as well, more clarity and transparency from there. So I think this process needs a bit of a healing time and trust comes back in the space. The fundraising portion will consequently come along as well.
Yep. Yeah, I was on a panel yesterday on exchanges, and the trust certificate is definitely something of paramount importance. In banking, in any financial intermediation, in fundraising, it's investors entrusting their money into something, a resource that they feel will yield the return based on the risk. And the risk is the level of return required for the cash that is imparted. So with digital asset space and fundraising going forward, I think it's multi-pronged. It needs to be a collaboration, a partnership between the public, the investors, the private sector, either the issuers or the corporates, or private investors themselves, and the government, right? So the government has to support the whole ecosystem. The policies have to be conducive for both the issuers and the investors so that it becomes an attractive market for investors to participate in, and it's an attractive market for issuers to actually feel confident that they will get funds in. And not only that, I think it's got to be borderless, right? It's got to cross borders, because with a lot of these digital assets, a lot of companies nowadays are going global. And the scalability of an enterprise is what will get it to a going concern at a sustainable level. So, you know, it's not just within a domestic environment. It's got to be a collaboration between policymakers on both the monetary, fiscal, and also the regulatory side across different borders. So I think we have a lot going. There's also simultaneously education process, particularly in the deep tech and the constant understanding. And things are moving faster and faster, right? So where someone's brain is still operating on a 256 kilobyte processor speed, get up to M2 speed. It's now M2, right? So yeah, it's all exponential, yeah.
Great. So it seems that we all have something in common, including myself, which is this whole new ecosystem of the digital assets world. To me, it must be grounded in two things. One is in trust, because of how fast and how dynamic the business models are. And trust meaning in the founders, right? And innovation, right? That will provide significant opportunities for growth. Growth meaning more money, right? More businesses, and more improvement to our lives. And that's what technology is there for, right? So as such, I'd like to open to the floor. If there's anyone that would like to pick the brains of the esteemed panelists here. Okay, if not, thank you very much for your time, and the esteemed panelists. Thank you so much.